how else do you think about that? Well, I said at the beginning, I don't have a problem thinking that the market can go lower,
No.
but still buying. The question is,
Yeah.
how much do you buy? Suppose if you think that this is the bottom to the day, then you should go all in.
Sure.
Right? You shouldn't be hedging or screwing around. You should put everything in, because today's the very bottom, right? If you're not sure if today's the bottom, if you're maybe 50-50, then you should put half of your available capital in, right? If you actually think that this is almost certainly not the bottom and it's going to fall, it's going to crater, by another 20 or 30% from here, then maybe you would only put 10% of your deployable capital in.
So totally understand that. Makes total sense. So now you've got a set of opportunities. How do you filter which set of opportunities takes priority in the portfolio with the amount of capital that you want to deploy at any one time? Because this is where the dark art of portfolio management comes in. Yeah. It's never that easy.
Well, I think and this kind of relates back to the what we were just discussing about predictions about where we think this is all going to go. It's all very interesting. We all have a view on the future. We all have predictions. We all like to compare predictions. But I think that I find it easier to react rather than to predict. Right? I think reaction it's almost an easier kind of thing, because the market will ask you questions and you can answer yes or no, right? Whereas when you're actually kind of trying to predict and you're trying to figure out where it goes, then I think it becomes much more complicated. So when you're reacting, and I think these are the markets where you're in reaction mode. Do I like these prices? Do I like the price of this security? Do I like the price of this asset class? Yes or no, right? You can answer those questions reasonably easily. I think that it's too late to be looking for new investments here, right? You shouldn't be dusting down your file on that company you meant to have a look at 6 months ago because it now looks quite cheap. It's too late, right? It's too late. Either you know it or you don't. You should have been doing the work 6 months ago, right? You should have been doing, you should have been doing the work when you had plenty of time, when it wasn't a fast market, when it wasn't such a rapidly moving situation. That's when you should have been doing the work, whether it was for a company, whether it was for a security, whether it was some kind of slightly complex trade or a manager. Now is the time to be pulling the trigger on the work that you've already done. So in terms of how do you decide which one's which? Well, I think the filter is very easy at this stage. Have I done the work or have I not done the work? If I've not done the work, then I'll leave that for later, because right now, and I'm pretty sure it doesn't matter which market you look in. If you are a credit trader, you will see there will be some credits which you don't need someone to tell you, or that these offer great value. Why? Because you've been trading this stuff or watching this stuff for years. If you're an equity trader or an equity investor, it's exactly the same. You've already got your watch list. If you're a CLO trader, or if you're an allocator to different managers, you know what your universe offers you. And I think that at a time like this, it's a time to pull the trigger. It's not the time to be doing, new detailed analyses. I think, that was for kind of, that stopped in January.
So going down to the next level now, across asset classes, where offers the better opportunity? And another question as an addendum to that is, how the fuck do you deal with a portfolio where bonds don't work any longer as well? If you're constructing a multi-asset portfolio, Anyway, so the two questions is what asset classes look particularly interesting as we're drilling down, and how do you deal with bonds that don't really work in a portfolio or potentially don't?
Yeah. So I think the one that stands out on a risk-adjusted basis, I think would probably be CLOs. I think across the kind of CLO capital, when you get kind of a little bit more senior into the kind of CLO capital structure, you get to double Bs, you're getting a kind of double-digit return, 10, 11%. For double B. So that's obviously that's still sub-investment grade, but the kind of credit performance of CLOs versus the underlying credits is historically been incredibly good, far too good. You can normally, if you're willing to to basically do your homework and accept the complexity that comes with CLOs versus vanilla credit, you're probably going up a notch, maybe even 2 notches in credit rating in terms of the expected defaults that you're likely to suffer. So 10 or 11% for, in kind of vanilla credit equivalent terms, triple B, maybe even single A. I just think that that's kind of phenomenal value. It is an opaque market. You need to know how to access that market. You need to know who the managers are.
And you need to understand it. It's not a simple market.
It's not a simple market, but, I think, again, as I said at the beginning, one of the things I find very interesting are these very deep principles, which are true across all. It doesn't matter what you're doing, right? The principle for Jim Simons and the scientists at Renaissance Technology, before they're actually deploying a model, the fundamental principle which they are deploying is exactly the same as the fundamental principle that Buffett and Munger would be deploying when they're allocating to a new business. Do we understand this? Right? Do we understand?
A lot of people don't ask that question.
No, they don't, but they should be. And that is, one of my heroes is Richard Feynman, the physicist, the Nobel Prize-winning physicist. And he was talking about doing science, and science is, in essence, is not so different from investing. It's trying to understand reality, right? And what Richard Feynman used to say was, just, when you're doing science, just remember 2 things. Rule number 1, don't fool yourself. Rule number 2, you are the easiest person to fool, right? Always bear those 2 things in mind. And when you're doing investment research, it's the same. Now, yes, are CLOs complicated? Yes, they're not that obvious, but how much time do you need to spend to roughly understand the basics of what these things are and what the risks are? It's not rocket science. A little bit of patience, a little bit of kind of willingness to ask some dumb questions to people who know, and people who trade this stuff. I think you end up in the same place. If you're going to look at catastrophe bonds, or if you're going to look at life settlements, or if you're going to look at Booking.com, right, or if you're going to look at Google, or Exxon, you're going to have to get down and dirty with really understanding what the hell is going on under the hood. And that, or if you're building algorithms for Jim Simons, right, you're going to have to do some pretty serious work, go down a bunch of dead ends, throw your hands up on multiple occasions saying, I don't understand this, I don't, and then eventually persevere and you'll get there. And so I think that, subject to a willingness to walk away if it's genuinely too hard or you genuinely don't understand it, right? Then, I think that spending time understanding how different investments work is just a very, very good use of your time. And it's a very profitable use of your time at times like this, when, as I said, you get dislocations kind of, I think in pretty much any market you look at, you can see dislocations.
Go back to that bond question, treasury bonds and that, how that works in portfolio construction. Have you got any thoughts on that? Because a lot of people are just starting to scratch their heads and think about it. And do I substitute it with something else? Can I use gold in its place? How does that world work?
So I think it's kind of interesting. If you go, where do you start? Okay, I'll give you the simple answer. I think is this. And by the way, I haven't properly done the work yet.
Yeah, no. I'm just picking your brains on it because it's just come up very quickly for everyone. It was like, oh shit, okay.
It suddenly has. Yeah, it's funny. But if you look at they've got, I think it's Deutsche Bank indices, but they actually have long put, long index hedges, right? So put hedged indices on Bloomberg. You can look them up. They've got them for the DAX, for the CAC, the FTSE, I think for the S&P.
And it applies a certain delta option that you buy every month or something of that sort.
I think it is, from memory, I think it's 5% out of the money, which they roll quarterly. It might be at the money, but I think it was 5% that they roll quarterly, right? So this isn't a particular. You could do far better than this if you just spoke to your bank and got them to kind of, rebalance it weekly or monthly, right? Because obviously, if you're buying a put option, in end of December, and then the market kind of goes up 20%. January, February, and then your kind of put option has, it doesn't actually afford you that much protection for a March drawdown, right? But nevertheless, that's what these indices show. If you look at the total return for this index, and compare it to the total return of the DAX index, which is a total return index anyway, the difference over the last kind of 20, again, it was a few weeks ago I looked at this, but I think it's round about 20, 25 years worth of data, right? The difference between a fully hedged index and just a naked index is 90 basis points. In other words, it only costs you 90 basis points to hedge with a put option. Now, if that's the cost of hedging a full equity portfolio, I think that I would rather have a portfolio of puts in my portfolio than to hedge my portfolio than 40% than the 60-40. Well, 60-40 basically just is dampened equity, right? I can dampen my equity.
Well, because they were both correlated, so you got the double kicker, so it made everybody with an all-weather fund look like a hero for a while, right?
Although historically they haven't. That correlation has not been stable.
No, it's not.
It's really so that there is a potential kind of disaster where actually, you basically get this. You don't get the hedge there when you need it, right? From the bond market. And if you've got the leverage risk parity, then you're clearly in trouble. But again, subject to having to actually broaden that type of analysis, but that's quite promising, right? It only cost me 90 basis points through the cycle to hedge 100% of equity portfolio with put options, with vanilla put options. I think that could be the answer. That's what you do instead of bonds.
Yeah, I mean, it's super interesting. What's the variability of returns? Because it's very easy if you're in a family office to say, well, 90 basis points over that period of time is fine, but if the variability of the 90 basis points is, 1 year you're lagging by 10%, this in this stupid business nobody will accept it.
Yeah.
Do you know anything about that or not?
I mean, I think the volatility was less, the drawdown was lower. I think that the question you ask is such a good question, and I think for any money manager, it's just it's if you had answering that question is the holy grail, because it's not, you're asking that question for that particular strategy. You could actually ask that for anyone who thinks they might outperform for a couple of years. And I think that the answer is to the extent that there is one, is I'd say two things. One, education. So be as crystal clear as possible with your investors about exactly what you're doing and exactly what they can expect, so that when it does happen, you can tell them and it's not a surprise. That doesn't guarantee you anything. I think it might buy you an extra year of underperformance, but that can keep you in business. And the second thing is, deliver what you promised. So if you're kind of trying to educate, you're trying to promise investors and say, look, here's what we really can outperform over the cycle, but there could well be 2 or 3. If we follow this exact strategy, we would expect, 2 or 3 years of underperformance every 10 years, right? I think if you can really get that, don't sell them something that's not attainable. Don't sell them, constant outperformance and without any period of drawdown, without any period of underperformance. This doesn't work. And bizarre, you do see people do it because I suppose it sells. But this is the asset gathering kind of strategy, right? Where you have like kind of 20 funds. And you tell the kind of investor that every single one for every individual case, you say, oh, this one's just going to outperform forever. This one, right? And of course, most of them don't. But just statistically, 1 or 2 of them will do. So they're the ones that get all the inflows, right? And
then they stop outperforming. Yeah.
So yeah, I mean, I don't have a better answer than education, deliver what you promised, and and kind of hope, really.
So let's get down to more specifics now. What are the areas that you're focusing on? So CLOs, that's an area that takes, as we talked about, more of a skill set. In equity terms, is there kind of particular sectors that you're looking at, or are you very, very special situation, single name driven? How are you looking at this?
What kind of interests me? I think that I think that some of the emerging markets are kind of interesting. I think that a lot of emerging markets were interesting before this happened, before we had this recent kind of episode. I think Russia's been interesting to me for some time. We've been invested in some Russian equities. Sberbank in particular, I think, is
what's interesting about Russia for you, because it's a market that people fall in and out of love with.
Yeah.
As far as I know, most people aren't involved any longer.
Well, so that's already a part of the answer.
Yeah, I figured that much.
I think so. Russia, to me, is not. Yeah, it's not a view on Russia as such, right? It's not a kind of macro call on Russia. It's just that, like any index, there are, I mean, to varying degrees, but any equity index has got, good companies and bad companies, and well-run businesses and badly run businesses. And Russia has some very well-run businesses, some not that many, but it's got some well-run businesses. And one particularly, I think they have one of the best-run banks in the world in Sberbank, which is a kind of fortress balance sheet, unassailable position in the Russian market. Without kind of spending 20 minutes with a kind of articulation of the investment thesis, I think this is about as bulletproof as you get as far as banks go. It's kind of like the JP Morgan of Russia, and that you have a very rickety banking system. Every time there's a downturn, the banking system gets crushed. And when people do pull their money out of banks, when there are runs on the banking system, they put their money into Sberbank, right? Because it's the last man standing, it's the highest quality name. So in terms of the problems, the structural problems that banks have, i.e. bank runs, Sberbank, if anything, benefits in that kind of environment and gets stronger in that kind of environment. The other problem the banks have is this kind of structural mismatch between their assets and liabilities. So they've got very short-term liabilities and deposits, but they've got kind of longer-term assets in terms of mortgage loans. And this often kind of eats into equity when there's shifts in relative interest rates. Most emerging markets, and certainly Sberbank, they actually lend floating rate, so they don't have that mismatch either. So they have a very, very kind of robust business model, very, very robust brand in Russia, and they have extraordinary margins. Emerging market bank margins are far, far wider than they are in developed markets, because you don't get the same competition from capital markets. So emerging market banks, I think, are kind of different animals than their developed market counterparts. You've got a bank that's regularly earning in excess of 20% return on equity, and it's trading at a 20% discount to book value. I think that you're getting very, very good. From that's very, very easily a double-digit return, in my opinion.
Have you come across the family office? I won't mention their name. That only does this. They only do emerging market banks.
No,
and they amazing. I should introduce you.
Yeah.
Amazing. I mean, it's a big family office. They've made a fortune, but basically they only focus on emerging market banks. There were the Nigerian banks, the Indian banks, the Russian banks, and all of this. When nobody else is looking at them and everybody's puking them, they're the guys who go in and figure out what, because it's kind of one trick that they know really well.
Well, it's something that I discovered when I was at Calibrium. One of the analysts that I had, incredibly switched on, brilliant analyst, brilliant investor, and he was the one who basically educated me on emerging market banks, and he'd come from an emerging market background, and I think I had many of the prejudices that we all have about banks. So they're structurally unsound business models, structurally leveraged business models. You don't make a good business better with leverage. That's just banks. Always blow up during a crash. And of course, every single one of those kind of things has an element of truth to it. But it's not quite the same in emerging markets, and
it's also what discount you got when you buy them, and what the tailwind is. Many of these emerging markets have great demographic tailwinds. For example, anything in the Middle East, for example.
Yeah, although not Russia.
Not Russia. It's the opposite. It's a demographic brick wall.
Yeah, real problems there. So I said, the Sberbank is something that we own personally in our own portfolio.